My name's Morris Davis. I am not at the University of Wisconsin. I don't know who Wisconsin paid to get their name on the program, but it wasn't me. I'm pleased to be the moderator of the second panel, which is about the housing cycle, case studies on intrinsic value. And for our presenters, we've got Andreas Kunert at VDP Research and then Stephen Olener here at AEI. Each presenter will have 30 minutes. Then for discussants, we'll have Noreen Braden at Marshall & Swift, Lance Coyle at the Appraisal Institute, and then Bob Dorsey at FNC. Each of the discussants will have 10 minutes, and that should leave us plenty of time for Q&A at the end. So if we can follow the same rules that we had at the last panel, make little notes as the presenters and discussants are giving their presentations, and then at the end, you know, hit us with your best shot. So, in terms of questions. So, okay, for presenters, let's start with Andreas Kunert, telling us a bit about Germany. Berlin in particular.
Yeah, thank you, Morris. Hello, everybody. My name is Andreas Kunert. I'm a senior analyst at VDP Research. And I'm going to talk about the characteristics of the real estate market and house price developments of land and house prices in Berlin, in the Berlin metropolitan area. But first of all, okay, sorry. First of all, before I start, I will give you a short oversight of the background of my company, the VDP Research GmbH. We are a 100% subsidiary of the Association of German Pfandbriefbanks, and our main aim is to analyze the German real estate markets, and for that purpose, we have developed and maintain a database where we are to this date have 260 participating banks from all three tiers of the German banking industry, private banks, saving banks, and cooperative banks. And they give us their data from the transaction, from their loan origination, and we get all the transaction information like transaction prices and condition of the building and all kind of information about the real estate, so that we can use in our models for hedonic analysis. And the research we do is there are three main themes. As monitoring, we're monitoring. This means that we are monitor real estate markets for commercial and residential properties on a zip code level yearly, and that goes into the risk management for the banks. And then we provide, of course, there's our time series and forecasts of residential and commercial risks. And we also do with the data, we have valuation parameters for the banks to evaluate their properties and market valuation, and of course, Pfandbriefbanks mortgage lending value. Okay, so this is what we're talking today is the research program. The idea for this research was on last year's conference when Steve presented his research on this topic for the Washington D.C. metro area. And afterwards, we talked about the possibility to do the same kind of research for Germany. And here are the two aspects of this research. On the one hand side is the assessing of collateral risk in German housing market, the final level of geography. We see that in the later presentation by Steve on a zip code level for Washington D.C. and many more metropolitan areas in the United States. And the other question was are there differences between countries in comparison to Washington or American metro areas. So what I will do today is I will describe the characteristics of the residential real estate market in the metropolitan area. Here the focus is on single family homes, and I will present first results for the city of Berlin. And so I will do, we have the, to do this research, we have 3 data sources here, which we use. We have our transaction database. There's data from since 2003. We have about, well, what I've mentioned before, is about 260 banks. The data set contains, here's an error, about 2.3 million transactions for residential and commercial properties. But we need the data from 1990 backwards, so we need another source for data. And we have a unique source in Berlin. It's called the Local Real Estate Surveyor Commission. This is a semi-official entity where all the transactions that are taking place in Berlin were noted, and the transactions were analyzed by this Local Real Estate Surveyor Commission. It's highly data protected, so I need the help from Morris and Steve to get a letter from the university to get this access to this data. Thank you very much for that. And they they analyze the transactions, and they publish land values. That is unique, I think, in Germany. We have official land values for lots in Germany. And the data set I had access to is about 46,000 transactions of single-family houses in Berlin. And the last source of data are the construction costs. This is only for Berlin as a whole. We have no zip code level data or access to. And this is from the Statistics Department of the land of Berlin. So I will focus first on the metropolitan area. It's not only Berlin, it's also surrounding districts from the land of Brandenburg, as you can see here. This picture, as you see, in the Berlin metropolitan area, that's a gray shaded picture, are living around about 4.5 million people. So, but in Berlin alone are 3.4 million people. So it's a very high dense city. I've pictured the wall. Here you see the red line is the former wall of Berlin. Of course, it's not there anymore. Only some bricks in the streets. And it is divided Berlin in the eastern and the western part. And you see, we do some. I will show some graphs which divides the analysis into the eastern and western part. And you see the area surrounding Berlin. This is a greater metropolitan area of Berlin. And if you show the next picture here shows the share of single-family houses of all houses in the Berlin metro area in 2013. It's by quintile. From the highest is the greenest, green part, and the lowest share of single-family houses. What we expect is in the center of Berlin, where normally there are condos and multifamily housing, of course. And here in the southwestern part, the yellow sign is the capital of Brandenburg, is Potsdam. It's also a highly dense city. And so you see the market for single-family houses is in the outskirts of the city of Berlin and in the metropolitan area surrounding the city. The next picture is what I will present is the purchasing power per household. One remark, sorry, I forgot. If you've one kind of structure in Germany is the home ownership rate. I think that's different from the United States. In Germany as a whole, we have 45.9 as a home ownership rate. We have a very strong rental sector in Germany. As opposed, I think, to the US or to other countries in Europe. We have the lowest home ownership rate in Europe. And in Berlin, the things are even worse. In Berlin, the home ownership rate is by 15.6%. That's a very low, it's the lowest home ownership rate in Germany. In Brandenburg, of course, a little bit higher because it's more rural areas. It's about 44.9%. Okay, sorry about that. So the purchasing power is, it's another picture. Berlin as a whole has a disposable income of about 33,000 euro per annum. And Germany as a whole, on average, 42,000. So in Berlin, the purchasing power, in comparison to Germany as a whole, is about 22% lower. Yes. And also, you see the richer households are in the surroundings in the southwestern part of the city. This, of course, it's a nice part of the city. It's very green. There's the Lake Wannsee. There's the Grunewald. It's very green areas of the city, and there lives many rich and famous people from Germany. This is a very expensive city. Part of the city. Sorry. So this is also comes true if you go and to see the average land price per square meter. This picture is taken from the local real estate local real estate surveyor committee. You see here the lowest, smallest land price is 31 euro to 140 euro per square meter. That's in the lowest quintile, and the highest quintile is about 490 to 2,000 to 1,200 euro per square meter. The red areas, and the white areas are areas where the share of single-family houses below 50%. So I've blanked that out because it is not an area for single-family housing. And the red spot here, which you might see, is in the middle. This is the former airport of Tempelhof, and there's a little. This airport has a surrounding of single-family houses, and this has the steepest price increases we have seen in Berlin for single-family house, because it's this area is the nearest to the city center. So these are houses from the 50s, and we see there that the strongest price increases in Berlin, of course, of its centrality to the city center. So here on the next picture, you see the house price change that we measure with our data from 2007 on a zip code level. This is data which goes directly into the collateral risk monitoring of the German banks. It's by zip code level, and you see here their price increase from 2007 to 2013, nominal price increase, I must say, from less than 10%, it's the yellow areas, up to 32%. Which is a huge price increase for the last years in Germany, because we have a lot of years there was a stable market, and only in the last 5 years we saw steep price increases. Also, you can see here Tempelhof. So this is all the data we had for the metropolitan area, and now I turn a little bit, zoom in to Berlin, and try to give a picture of what is the supply and demand situation in Berlin, and then I come and try to analyze the real estate data and try to decompose the house price increases into a cost factor and land value. It's like the same kind of research Steve will present later on a lower level. So you see here, you see here the city of Berlin, And here are the transactions of single-family houses. This is data from the local real estate surveyor commission. You see all the points are one transaction, 46,000. I've said it. It's very a low number, I think, for this time span from 1990 to 2013. And you can see here on this pictures where the hotspots of the transaction are. This is, of course, in the surroundings of the city, in the southern parts, in the southern eastern part, and in the northern part. This is the airport Tegel, who will be closed, I think, in about, he should be closed already, but he will be closed in 2 or 3 years. We have some problems with the new airport in Berlin. But I think this is, these effects here you see is the effect of the expected closing of the Flughafen airport Tegel. So what is the picture of the demand? And this here is the development of the Berlin population. You see from the 1990s to 2013, and this is quite a cycle we have imagined, we have measured in Berlin. 1990 was the reunification of Germany. There was a big house price boom after that, and it broke down in the 1996. And then you see here that we have a positive population change in Berlin up to 1995. Then there was a negative migration balance for a couple of years, and now since 2003, 2004, we have strong increases in population in Berlin. The last 3 years was about 40,000 people a year that come to Berlin, mostly immigrants from Europe. There's a trend to urbanization trend in Germany. So you see that picture for all greater metropolitan areas like Munich or Cologne. And the scenario is, the forecast is that Berlin will access up to 2030 about in the medium scenario about 13,000 people. About 255 more people in 2030. If you see that, the demand side and the average household in size in Berlin is 1.73 persons. So there's a great demand for housing. And if you see on the other side the supply, that's very interesting. This is supply side. This is the new completed dwellings by house type. The blue bar is multifamily houses, and I mean multifamily houses as condo. These houses with 3 or more dwellings that can be used for condos or apartment or rental. Yes. And you see here also the cycle in the completed dwelling in 1996. It was or 1997 was the high tide of building, and then it goes back radically, and now we are on a level about 4,600 dwellings a year. That's nothing. Yeah, that's very low, and Berlin has a vacancy rate of under 3%. So basically, their supply and demand are on a very strange level there. And if you see the dwelling stock, we have about 1.8 million dwellings in Berlin, and houses are about 10% of the single-family housing. Berlin is of course a multi-family area, like all major cities. Yes. So, and what about the transactions of Berlin? This picture, this is also transaction from sorry, it's up up from 2000 onwards. These are the transactions of single-family houses in the western part and eastern part, and on the right-hand side of this picture, there's a transaction volume. And what you can see is there's clear trending, trend up for the transactions from 2007 onwards. And what's striking about the right-hand picture is also the trade volume goes up. So that means on average the prices are going up really fast. And but interesting is only the transactions from are only 1.6% of the dwelling stock per year. So it's really low rate of transactions in comparison to the dwelling stock that we have. We are only so now to the core of the analysis. I've done two things. We have estimated to try to see to decompose the volatility of land values and costs and house prices. We have done a quarterly house price index as a cost approach. I think we have PC, it's a price, cost price is defined as land share times the land value plus 1 minus alpha t, also 1 minus the land share times the cost. And this, I think, is from a paper from Morris Davis and what I don't, sorry, the second Palumbo, is it? Okay, thank you. We use this to decompose house price index. I estimated the land values from the local real estate surveyor commission, and we have the cost index observed from the statistical department of the land Berlin. The land share in T-1, for the first time I've used the land share of average building in 1991. It's about 59%. It's very high, yeah. But it's maybe this is shown the course of the post-German unification boom, and I think also the data from 1990 to 91 is a little bit critical to, because they are. Before, in the eastern part of Germany, there were no data available. So I I estimated this index, and you can see it here. We have the cost index, the blue one. We have the land value index, which is the light red one, a line, and the house price index is in between. So, of course, of the land share, the house price index is in between the cost index and the land value index. And you see it's very, the land value is very, how to put it, sluggish. Very, there's no, and at the end is there's no dynamic you can see here. And the first, from the time spent from 1990 to 1996, where the house cycle, the housing boom was in Berlin, you see steep increases, and then you see a large decrease up to 2005, and now it's getting a little bit, you see a slight increase here, yes, in the estimated. From the real data, from the data, the local real estate surveyor commissions are this official data, the index of official data. So, but we can do another kind of analysis here, because we have all the house price data. I can do a direct measurement of house prices, and I can do a hedonic index. And this is the equation here under the pH. Then I fit a hedonic model with area, age, fit out all the ingredients that we have access to, and then I do a time dummy approach. Also for every quarter, one time dummy, and of course the epsilon, and then I have the direct measure of the house prices. So, and jetzt, if I compare these two, you see here the lighter line, the light red line is direct measurement house price index, and the dark red line, I hope you can see it, is the cost approach. So what is striking is the cost approach at the beginning. The direct index is increases at a lower rate than the pure cost approach index, but at the end it goes. The increase is far more dynamic than the cost approach index. So what can we do with these two kind of indices? We can compare them, and we can yeah, thank you. I can do a relation between them. I can make a relation between the direct measurement and the cost approach. And you see here, if I do pH in comparison to PC, then I have this movement here. You see here, this is how much is lies the market values, or about the cost prices. Yeah, this is the direct price, and then it's the cost price, the replacement cost. So it's something like Tobin's Q here. What we see, or we can interpret this as Tobin's Q. And you see, if this goes up over 1, we have an indication of overvaluation. And if it is under 1, then it's undervaluated. And this mimics the same the price cycle fairly well in Berlin. I would not say that it's at the end it is in Berlin the prices are overvalued, but we are getting there. And if you do the long run average of this, it's nearly 1. This is a very interesting finding, as what it's supposed to be. It should be near 1. This is a long, but this is already in taken care of in the German appraisal literature. This is called the market adjustment factor. This is in the replacement cost approach. The appraiser builds a house from the cost approach, makes the depreciation, and after that he adjusts the depreciated replacement costs with the market adjustment factor. And this is the thing behind me. Yes. We can do it another way around. We can do that what Steve has done, the land value as a residual of the direct house price measurement, and we subtract the construction cost, and we get this picture here. And we can compare these two measurements, the land value residual and the land value that I've direct estimated. And you see here, what is striking is that if you take out the early 90s because of data faults and data errors and so on, then you see that the residual value is much more volatile than the direct measured land value, which is official, and you have to use it for valuation in Germany by the local real estate surveyor. So at the end, you can see here what is that the land value, the direct land value lacks the dynamic development in Berlin in the land value, as opposed to the residual land value. So basically, this last picture says that in terms of standard deviations, that the residual value is much more volatile than the direct measured land value. So results, land price volatility is greater than house price volatility. That's the same thing what Steve has found out, and it's greater as construction cost volatility. Due to the unique data situation in Germany, for example, land value transactions from local state survey commissions, we are able to identify market volatility. Volatility of direct measured land values is greater than volatility of direct measured land values. Indirect measurement of land values based on a pure cost approach, and the cost approach overstates the cyclical development of land values. That's what I found out with this data. But okay, final remarks. This was a great thing to do, but getting data at the zip code level before 2007 in Germany from land values and so on is nearly impossible. This changed after 2007. The data situation is better. Unfortunately, the time span is too short to identify cyclic up and down swing, because since 2007 Germany has only an upswing. So we cannot do this kind of analysis from 2007 onwards. But the good thing is we can use the insights of this kind of research to improve our monitoring of the German real estate markets. Thank you for your attention.
Great, thank you, Andreas. Next to present, Stephen Alliner from AEI.
Thank you very much, Morris. I'm really happy to have the opportunity to present this research, which is joint work with Morris and with Ed Pinto. I'd also like to personally thank two of the people who are up here with me, Bob Dorsey and Noreen Bryden, for the work that they did at a personal level to help us get these data, without which we just could not have done this research. So thank you. If you do not yet have the paper handout for this presentation, House Prices and Land Prices Under the Microscope, there are additional copies at the back of the room by the coffee. I'd strongly recommend you get one, because there are going to be some slides that you're not going to be able to read very well from the screen.
Steve, can I make the request that you pull the microphone slightly closer to you?
Sure. Great. Okay, thanks, Morris. So one of the themes of our conference, and indeed of this work, is that a key lesson from the financial crisis is that we just didn't have nearly enough information to understand the risks that were building up before the last bubble. And so this work is an attempt to try to fill that gap in a particular dimension, and that is by quantifying collateral risk, house price risk, at a very fine level of geography. As you'll see, we focus on land value because this work and a lot of prior research, and Andreas's work as well, has indicated that land value really is the risky part of the housing bundle. The other part, the structure, has a more stable value. We do the estimate of land value at the property level using the data from FNC and Marshall Swift CoreLogic. To our knowledge, no previous study has actually done this on the scale that we're doing this now. And we use the results to characterize the housing boom and bust in the Washington, D.C. area. And we now have as well some results for Boston and Miami as we're continuing to move to additional metro areas that I'll present in somewhat abbreviated form, but you'll see that they're consistent with the results for D.C. So before I get into the meat of the presentation, let me just give you the key takeaways. First is that land prices, as we estimate them, were more volatile than house prices. This is, as I said, a standard result. What perhaps is new is that we find that they were especially volatile in the parts of the metropolitan area where land prices were initially low and where land only represented a small share of value. In those areas, the land share of value jumped a lot through 2006. And importantly, we found that this jump is a useful predictor of the magnitude of the house price decline on the downside. So the key thing is that if you just look at what's happening to house prices on the upside, you don't have full information about how much risk is building. Looking at the land prices separately gives you information that you can't see from the house prices themselves. So the scope of the paper, the data are for detached single-family homes. The main results that I'll present are for 8 jurisdictions in the Washington, D.C. area, the city itself, 5 areas in Virginia. The counties are listed here: Arlington, Fairfax, Loudoun, Prince William, plus the city of Alexandria, and 2 counties in Maryland, Montgomery and Prince George's County. Ed and I both live in Montgomery County, so this was a good way for us to check whether the results looked reasonable and whether the data looked like, well, I don't know about that. So this was a good place for us to start. The results for Boston cover the 3 core counties in Boston. Norfolk, Suffolk, and Middlesex, and in Miami we have Dade County. So this is a table that has a lot of numbers, and I'm not going to go through these numbers anywhere close to one by one, but let me just make a few key points. The individual jurisdictions in the Washington area are shown first in dark blue for Virginia, light blue for Maryland, and then DC, and then the orange or orange color is the U.S. total. So first off, all these jurisdictions together have a total population of just under 5 million people. So it's roughly the same size metro area as Andreas was working with for Berlin. The DC area is affluent. If you just scan the median, down the median household income column, you'll see a lot of numbers either above 100,000 or close to 100,000. Median income in the United States at the household level is $52,000. It's a very well-educated population. Again, scanning down the next column, in most of the jurisdictions, the majority of people have a bachelor's degree or more. In the United States as a whole, 29%. And it's also an ethnically very diverse area. I'm showing here the Black and Hispanic share of population. Of course, there are other minorities as well, but this is something that we highlight because so much of U.S. housing policy is oriented toward raising the home ownership rate for these groups. And so I think it's instructive to look at what kind of house price risk is in the areas that have large population shares for Blacks and Hispanics. Within the metro area, there's a lot of variation across these jurisdictions, and Arlington, Fairfax, and Loudoun are basically high income, high education, low Black and Hispanic share places. Prince George's County has lower income, lower education, and a very high minority share. So we'll be contrasting what happened in those areas. And finally, the other areas are basically a blend. Some have higher income, some have higher education, but they're not at the polls. So the data that we're using for this analysis, as I mentioned, comes from FNC and Marshall Swift CoreLogic. From FNC, we get information at the house level on characteristics, exact location, year built, sales history, and FNC's estimate of its current market value. From Marshall Swift CoreLogic, we get the estimate of the reconstruction of the house as a new house. In addition, we use zip code level data to move these property level values forward and backward through time. And the data set as a whole has about 680,000 individual detached single-family homes. We have as our basic geographic unit what we call the zip group. For many zip codes, it is just the zip code itself, but some zip codes don't have very many houses, or they don't have they may have a sizable population, but they don't have very many single-family detached houses. So to make sure that each unit of observation in the analysis has a decent sample size, we've combined some of the contiguous zips into zip groups so that we have at least 1,000 detached single-family houses in the group. There are a total of 142 of these zip groups, and this is really important. The analysis we're doing is not on a sample. It's on essentially the universe of the houses. The 680,000 represent about 90% of the total U.S. census count of detached single-family houses in these areas. We could be higher, but we're pretty careful about trying to get rid of data that look questionable or outliers, and so we end up getting rid of 5 to 8% roughly of the sample that we could have used. So how do we estimate land value? I mean, it doesn't just come on a silver platter. Everybody would have done this already. So what we try to do is to create what we call a market-based stake in the ground for each house, which is at a given point in time, generally very close to the beginning of the sample in the year 2000. We calculate an estimate of the house's total property value, which in this case is its AVM, broken into the land part of value and the structure part of value. So it's market-based in the following sense. We take the sales of new houses in that zip in the stake in the ground period, which as I said is generally in the year 2000. We observe the sales price of the house. So there's no, of these new homes, there's no AVM there. And we have a reconstruction cost estimate as a new structure for that house. So we can just take the difference between the observed sale price for the new homes and the estimated reconstruction cost and back out an estimate of land value in that location. Since the location really is pricing a set of amenities, existing homes in the same vicinity should have essentially the same land value. The structure value will of course be very different, but the land value, because it conveys amenities, closeness to schools, employment, etc., should be roughly the same. So that's the sense in which this is market-based. We take an estimate of land value extracted from sales of new homes and apply it to the existing homes in the same area. And then since that estimate is really for a single point in time and we need to have a whole time series for every house, we use the house price index and the construction cost indexes that I referred to earlier to move that forward through the entire period through 2013 at the house level. And then we average over all of the houses in a given zip group, and those are the numbers that I'm going to be showing you. So now we've done our homework, now let's get to the fun stuff. So I'm going to have a series of heat maps. They all have the same structure for the DC area. So what we've done is to divide each of the zip groups into a quintile, with the quintile that it belongs to for the particular variable that we're showing. This is the average estimated house value for 2013. So the dark shading indicates those in the highest price quintile, the light shading in the lowest price quintile, and that shading convention will continue through each of the pictures. The counties are labeled for the ones that are on the exterior, just on the outside of each county. In the middle, of course, is the city of Washington, D.C., and completing the diamond in the middle is Arlington County, Virginia, and the city of Alexandria, which is shown in the small unshaded inset. So the basic pattern here shows that house prices are relatively low throughout Prince George's County. This is the area that I mentioned that had the high minority population. Somewhat higher, but not high in other areas that are outlying, and then quite high in what I call the band of affluence that runs from northwest DC, northwest through Montgomery County, and through the adjoining parts of Fairfax County, including Arlington and Alexandria. So there's quite a bit of heterogeneity in terms of house prices in this area. Incidentally, in terms of distances, how big is this area? From the north end to the south end is about 65 miles, so roughly 110 kilometers. This is our estimate of average lot value, not land price per square foot, but what it would cost to buy a lot in each one of these areas, given whatever the typical lot size is. And you can see it largely mirrors what's happening in house prices, which is not surprising since land contributes a great deal to the ultimate cost of buying a house. This is a picture of the average lot size, and this is important for a couple of reasons. It shows, first of all, that the lots close in are on average quite small, which makes good sense, and the lots further out are on average much larger. So for us, the first thing was, this is just a reality check that the data are actually okay. If we had seen that the big lots were in Northwest DC, we would have had a serious problem, but that's of course not what this shows. So this is an entirely sensible portrayal of lot sizes across the metro area. The second thing that's important is that this variation in lot size has implications for how we measure land prices, because if you think about two lots that are right next to one another, one is 1/10 of an acre, barely supports a house, but it does, and the one next to it is 2 acres. It can also only support one house because of zoning requirements. The one that is small is going to have a much higher land price per square foot than the one is large, because most of the land on the one that's large isn't supporting an additional house. It's just for privacy, screening, having a place for your dog to go out, etc. So the places that have very large lot sizes are going to have low land prices per square foot, partly just because the lot sizes are big. So if we're trying to really compare on an apples-to-apples basis land prices across the metro area, we need to do it on a standardized basis, and we do that as a quarter-acre lot. So everything that I'm going to be talking about for land prices is land price per quarter acre in different locations. And that's what we're showing on this picture. So this shows the distribution of land prices per quarter acre in each of these zip groups. And once again, it's very highly correlated with house prices, which is not surprising. Very low in Prince George's County, relatively low in outlying areas, and really high close in areas that have a lot of amenities that boost the land price. This is a picture of the land share of property value. So it's essentially the lot value divided by the house price. And this is a little more heterogeneous. There is definitely a correlation between places where land prices are high and land shares are high, but there's also some heterogeneity, and there are a few places where I'm not sure these shares are actually right. This is not a knock on the underlying data. It's just this kind of estimation is hard to do. And so, for example, there are a couple of zip groups in Prince George's County where the land shares are considerably higher than every other zip surrounding them. I'm not sure that that's right. So when we do our analysis, we do it two ways, using all of the zip groups and throwing out about 25% where the land shares are unusual or outliers. And I can just tell you, it doesn't really make any difference. We have a full paper where we do it both ways. It doesn't matter a lot, but I just wanted to point out that these data are great, but they're still dirty. And basically all real estate data are dirty, and that's just a fact of life. So this portrays the house price increase from 2000, which is the beginning of our sample, to 2006, which we take as the peak. That's roughly the peak in most of these jurisdictions. And as you can see, there's a lot of heterogeneity here too in the amount by which house prices rose. There's some rough pattern, some tendency for the increases to have been the largest in the outlying areas and smallest in what I termed this band of affluence running from DC northwest. But there really is a lot of heterogeneity, which is important because it would say that, as you'll see in the next picture, just looking at these house price increases wasn't a great signal of where they were going to fall the most. So keep this picture in mind as I go to the next one. That's what it looks like on the downside from 2006 to 2012. And what you can see is that Prince George's County looks essentially like a bomb zone. I mean, every zip in that county had very, very large house price declines, even though some of them did not have large house price increases. So there's a much stronger pattern, geographic pattern in the declines than there is in the increases. This is where the land prices are helpful, as it will turn out. So now let me try to get to the point of characterizing the broad patterns in the data. Everything so far has been for individual zip groups. Now let's combine those individual 142 zip groups into 5 groups that differ simply by the level of land price per square foot for a quarter acre lot at the beginning of our sample. So we're stratifying into quintiles based on whether land was cheap or expensive at the beginning of the sample and seeing what that aggregation shows us. So what you can see from the red line, comparing it to the black line, is that the places where land was very cheap to start, the red line, had a very extreme land price cycle. Prices rose a lot, and then they basically did a round trip and fell a lot. The places where land was most expensive, they rose, but not as much, and they fell a little, and now they're only about 10% below their peak. So there's a much more muted cycle, and the 3 quintiles in between line up as you would expect from the lowest to the highest in between those poles. This graph takes the upside part of the cycle, 2000 to 2006, and the red lines just show what the percentage increase was from that last chart that we looked at in land price, and compares it to what happened to house prices in each of those quintiles and to construction costs. So the thing that really stands out is that land prices rose more than house prices in each of the quintiles, and the gap was especially large where land started out really cheap. It rose several multiples of how much house prices rose. Moreover, the house price increase wasn't really very different as you look across the 5 quintiles. The blue line, the blue bars, yeah, it's a few percentage points different across, but it's not very much. That's what the point I was making about not learning a lot from how much house prices had risen. And then construction costs rose very little, something like 27% over this period. So what was really driving the house prices up was primarily what was happening to land. This is the same picture on the downside from 2006 to 2012. It's a very similar picture in reverse. The land prices fell a lot more than the house prices everywhere, and the land price declines were really large, truly staggering, you know, more than 70% by this estimate in the lowest land price areas. Construction costs continued to rise, so the cost element of housing didn't actually contribute at all to the decline. This is a picture of the land share of value for, again, the same quintiles, same 5 quintiles grouped by whether land is cheap or expensive. In the lowest quintile, the land share started at about 20%, skyrocketed by our estimates to almost 60%, and now fell to the mid-20s again. We've talked to a few people who are very familiar from the academic world with historical land shares. And these line up very well with land shares at the periphery in cities in the United States, which, you know, when farmland is converted into land to be used for housing, those shares are generally in the neighborhood of 25%. So this struck us as a valuable reality check that these very cheap land areas have shares that look reasonable. Of course, the shares for the expensive land price areas are much higher. They start at almost 60%, and the highest price areas rise some to about 75% and then fall a little bit. But again, the cycle in the land share is much more muted in the expensive areas than in the cheap ones. So then this raises the question, well, what can you do with this information? And so here we have a scatter plot that tries to demonstrate that there is some predictive power from observing what happened to land prices on the upside for what happened to house prices on the downside. This is just a bivariate scatter plot. I'll mention something about controlling for other variables in a moment. But what we see here is that on the horizontal axis, we just plot how much did the land share of value rise in each of the zips from 2000 to 2006. Each diamond is one of the 142 zip groups. And on the vertical axis, how much did house prices fall from 2006 to 2012? The significant negative relationship with an R-squared of about 0.3 says that the places where the land share rose a lot are the places where house prices subsequently fell a lot. Now, I mentioned we've also run multivariate regressions where we have other controls on the in the regression to see if, well, the movement in the land share is still significant, and it is. And in particular, if you include what happened to house prices on the upside as well as what happened to the land share on the upside in trying to predict what happened to house prices on the downside, the land share is by far the more important predictor. It stays very significant. So now I mentioned we had done some of the same analysis for Boston and Miami. Let me just quickly run through some of the parallel charts. The patterns, qualitatively speaking, are the same. If you focus, though, on the numbers on the vertical axis, you'll see that the magnitudes are different. So Boston, same general pattern in DC. Land prices outpaced the increases in house prices, and they were largest at the bottom end. But the absolute size of the increase was not as large as in DC. Miami, same pattern, but Miami was a market that went totally crazy, and so all the magnitudes are larger, but the pattern's the same. Now on the downside, Boston, same general pattern. Miami, same general pattern. Of course, the numbers are larger. And one thing to note is that in the lowest quintile in Miami, the land price, as we calculate it, actually fell more than 100%. I mean, the land price was less than zero. This could happen for a couple reasons. One, which I think is probably not the reason, is that land prices could go negative if there were significant costs associated with holding the land and not much, like taxes, for example, and not much prospect of using it in a productive way in the near term. That's theoretically possible, and it might even be true. But it's also possible that our methodology isn't exactly right, and we need to really check it against other ways of doing these calculations, and we're going to do that. So this is a signal that there's a little more work to be done. In terms of the land shares of value for Boston, roughly the same pattern. Thank you, Marcy. Great, thanks. And for Miami, essentially the same pattern too. In terms of the predictive power of what happened to the land shares in Boston, also predictive as in DC for the subsequent decline in house prices. Miami, predictive as well. The slope of the line is shallower, but it's highly statistically significant too. So I mentioned robustness checks. We're doing a lot of additional work. I'm not going to get through everything here in the interest of time, to try to check whether the methodology that we're using so far holds up when we do things in different ways. So now everything I've talked about so far is really descriptive. It describes what happened in this market, these markets, over that 13-year period. The question is, what was driving land prices? So we've now begun to assess the role of fundamentals in credit supply. This work is just starting. So next year's conference, we'll have a lot more to say, but now we have a little bit to say, and it seemed like it was worth showing you what we've got so far. So what I'm going to show you is for DC only, and just the correlation between land prices, changes in land prices, household income, and the availability of jobs. So this map, it's the same structure of the heat maps as before, shows the employment per working age person living in a given zip if you draw a 10-mile radius around the center of the zip and ask how many jobs are available in the year 2000 using census data for the zip that the working age person lives in and any zip around that zip that is within 10 miles. And what you can see is that the job-rich areas are really concentrated in two places. A band running north of DC from the center of DC and a band running west into the Tyson's Corner area of Virginia. Everywhere else, generally speaking, there weren't that many jobs. On the income, this shows the adjusted gross income from the IRS per household in roughly the same year near the beginning of our sample. Here, you see also a skew toward the north and west, but what you see is that the high-income areas run further north and further west into the suburbs than the job-rich areas did, but it's basically a north and west story. This is the change in employment between 2000 and 2012 using the same data within the 10-mile radius. And here what you see really is that the job gains were concentrated in DC and Northern Virginia. There was really a striking lack of job growth in Maryland. And you can see that by the sharp contrast between the western part of Montgomery County, which is all in the worst quintiles, and the adjacent areas in Virginia that are in the high quintiles. And you think, well, why can't the people in Maryland get to those jobs within a 10-mile radius? Problem is there are no bridges over the river. You have to go almost to DC to get the Beltway, or you have to go way up to almost Frederick County. So there's actually no way to get to those jobs with a commute of 10 miles or less. This is the same picture for the change in adjusted gross income. It doesn't have the same geographic pattern that's very crisp, although obviously these affluent areas had a lot of income growth. So what we do is we run a regression where we regress the quarter-acre land price per square foot from all of these zip groups on employment per working age person within 10 miles and average household adjusted gross income in those zips. Doing this at the beginning of the sample for data in roughly 2000. What we find is that employment and income, not surprisingly, are highly predictive of, highly correlated with high land prices and vice versa. The regressions explain about half of the variation in land prices across the zips. And if we do it with data at the end of the sample, the results are about the same. Yeah, thanks. I'll just briefly summarize. We've done the same thing for the change in land prices, and the results are roughly the same. There's predictive power, but depending on the precise regression you run, generally the income is more predictive than the employment change. So now let me just summarize, since I'm very close to being out of time. Housing submarkets clearly are very important in Washington, D.C., and I suspect will be true in every metro area of any size. The house price swing over the last cycle was mildest in the affluent close-in areas, much more severe in places where land was cheap, which is essentially the exurbs and places with high minority populations. The land prices were more volatile than house prices everywhere, but especially so in these places where land started out cheap. Any place that had a large rise in the land share, that was a signal that there was some risk about a house price decline later on, and we see that in the empirical work. And it really accentuates the case for looking at land prices as part of the monitoring toolbox for what's happening to housing markets. And regarding fundamentals, we have some evidence about an association between jobs, income, and land, but there's a ton more work to do. We're going to do that work. We're going to do the robustness checks, and we're in the process of extending this to other metropolitan areas. Thank you.
Great. Thank you, Steve. So first to discuss all of this great work will be Noreen Bryden from Marshall & Swift. And Noreen, you have 10 minutes.
Perfect. Great. Thank you. I want to thank Steve and Andres for the research because I think we're onto something here as it relates to identifying land values. It's funny, last conference I made a comment about being invited to be on the panel, and I thought maybe it's because I've given them data. Maybe that's why they've asked me to be on the panel. So this year, being asked to be on the panel, I went back and looked. 10 million records of data. So I think my theory holds, right? It's all about the data. So I want to put perspective on just 3 things. I want to put forward a compelling story to get back to the fundamental valuation techniques. I want to talk about Steve's research and the fact that he's determining that the land portion is the volatile portion of the equation when we talk land and structure. And then talk about Andres's research, maybe get a little bit more insight on the cost approach piece. Okay, so this slide was supposed to have animation, and it was supposed to come in with some images. I didn't know it was going to be a PDF. So I'll talk to it. And it's really just a reminder that we have great data. At Marshall & Swift, for over 80 years, we've been gathering and reporting on construction costs. It's all about the data. Right now, as a part of the CoreLogic family, it's really all about the data. The details give us good data. Data gives us good decisions and good information, right? So the whole point of the conference, the point of the research, is to take what we know, look at all the charts and slides, the statistics, and the after effects of what's happened. We know enough about the issues, we know enough about the statistics, the data, to make decisions, right? To make better decisions for policy change. So the idea of the conference was talk about new risk measures, but I'd like to put back out there that really it's not new to incorporate, as Joan says, the 3 legs of the stool for valuation. And part of that key component is the land. So the research gives us better information, but it's important to know in a historical context that Marshall & Swift has always been involved with the appraisal community, especially with the Appraisal Institute. 2 of our founding members also were 2 of 4 founding members of what ended up being the American Society of Appraisers. And what's interesting, that in the 1970s, they wrote an authoritative guideline about appraisal principles. Even though this has been modified and it's been changed over the years, it ended up being adopted and is now the USPAP requirements. What's really interesting is that the initial guidelines state that all 3 approaches should be done together. I'll quote that it says, all 3 approaches should not be viewed as independent of each other. The underlying philosophy is that these 3 approaches, market, cost, and income, should substantiate the findings of each other. So we're a longtime proponent of the cost approach methodology. It's a defendable methodology to identify value, tangible value. But the one problem within that equation is always land. So that's why Steve's research getting to land value is really key, and that's why we've been donating all the data. So when you think about the cost approach and its ability to act as a barometer to set the upper limit on valuation and act as a check and balance, you think that we need the pieces of data. We need to understand what's moving in the equation related to the structure, or is it the land? And it's interesting that in 2005, the managing editor at the time for Marshall & Swift did a white paper in which he talked about cost approach and tangible value. And he put out a warning that obviously prices cannot exceed what buyers are willing to spend at the time. But when there's a housing demand or there's a housing shortage, increased loan and mortgage transactions, how difficult it becomes to determine perceived value. What is the right number? So it becomes important that the cost approach is used as a value of measure. If it comes in well below the market approach, it could be an indicator that the level of increase cannot be sustained. So in the white paper, he identifies that appraisers would be well to incorporate cost approach so that there's accountability and transparency, but also to ensure that there's no overinflated values on the appraisal. So it's interesting, when I look at Steve's research, the things that come out and highlight the importance is that, 5 minutes, okay, that real estates deviate and then return to the mean, right? So if the house price reflects the amenity value of the given location, which makes sense because real estate is tied to location, 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 then maybe the ability to have consistent measurement of the land price within the cost approach equation gives us an opportunity to predict risk, right? Could be an early warning sign. Right? Clearest evaluation sign of clearest signal of overvaluation, as Steve's research is indicating, is in the outlying or the lower priced areas. So it makes sense. So land is originally purchased cheaper, it's developed cheaper, construction costs related to the structure initially cheaper or the same in that area. So when the market is improving and there's an increased perceived value, it's the outside, right, in the lower priced areas that gain the most of that appreciation. So then in reverse, when the market starts to come down, construction costs are fairly normative. They follow inflation. So what's left? The land, right? So the land piece is the piece that comes down and the depreciation is reflected in the value. Right? So I look at the data and I think, is there a practical application for us? Is there an opportunity to use the insights by saying, we have another measurement, we have a place to insert it into a well-known valuation method. Can we use it for something related to policy change? And Andreas, I'm really sorry that you don't have enough data to get to a longer-term view, because it'd be interesting to see, does the theory hold in other places outside the US? All right, some of your initial results are similar, and I don't know if they're similar because of the process. And then I know you're also using an extracted land value given to you as an official data point. And we have no idea how valid, right, or how accurate that is. So it's very similar to what we're doing where people back out of an equation the land, rather than getting to the land, adding the right value to the structure, and getting to the right answer. So if you do more research, I'll be interested in seeing in the correlations on that. When I think about Germany, though, I'd like to point out that they have one of the most stable housing and mortgage environments. And I think it's pretty confident to say that it's because they have guidelines which use multiple approaches to valuation as the determinant in their collateral risk. I think that's a key determinant for the stabilization. I think that we need, here in the US, something else as an additional barometer of risk. The studies are very relevant because they give us further insight to the volatility on the land risk. I'm thankful for the research, right? Because it gives us the opportunity to segment that risk, to know the components in that equation so that we can get to a quantified land value. It's important to get back to fundamentals, starting with the most stable value, which is the tangible value. So I said this last year, and I'll say it again this year. We're at a point. It's a call to action. We have data, lots of it. We have insight. We have an understanding, and we can see what has happened as a result of decisions made in the past. So it's possible to create operational solutions that incorporate the insight of the research and get back to a tangible value as part of the barometer, right, as part of the check and balance against the market approach. I also think we can create solution together, all of us, the data, which provides opportunity for monitoring monitoring portfolio for the regulatory need, establishing value, watching that over time, and then also looking at risk and being able to put in the right figures in our risk price modeling. So I look forward to more details. Right? I know there's some additional checking, right? Some robustness checking, but I think the theory is sound, and I'm sold. And I think that there's something that we can utilize in what we now have, right? We know that we can get something that's more valid and gives us an indicator of risk. So we continue to support the research, and we look forward to building relationships with those that want to bring research into action and develop solutions for the market. Thank you.
Great, thank you, Noreen. So next to discuss, Lance Coyle from the Appraisal Institute.
Good morning. I'm going to get right after it because I want to avoid the dreaded time's up sign.
Do you want someone to monitor your slides for you?
There we go.
Okay.
There we go. Yeah, I'm good. If you don't know who the Appraisal Institute is, we're an 80-plus-year-old professional society of real estate appraisers. We have about 22,000 members in 60 countries. For many years, we've been the largest publisher of real estate valuation textbooks in the world, and we continue to be. And we like to think of ourselves as one of the leaders in the development of the body of valuation knowledge. We certainly educated many thousands of real estate valuers through the decades and continue to do so today. As you know, through the years, various people have pointed fingers at the valuation community for various sins and evils. And that's, I guess that's another discussion for another day. But my basic message to you today is that if you want to avoid the destructive effects of the housing market cycle, and back in the 80s we had a crisis in commercial real estate. If you want to avoid the effects of that market cycle, then I'm going to suggest to you today that the appraisal community is part of the solution. Certainly the Appraisal Institute wants to be a part of that solution. And we can be. I'm not suggesting that we will cure all the problems, but I think that the appraisal community is ready to step up and do a part of it led by the AI. So Economics 101, here is a picture of the typical market cycle. Equilibrium is that theoretical line where supply and demand are equal. It is a theoretical point in time because it seldom happens and it seldom stays around. What does happen is supply and demand get out of whack, and therefore you have market cycles. Sometimes the market is rational and reacts rationally. Other times it's irrational. Sometimes there are outside influences that cause wide swings in the market cycle. So what is our reaction to this? The nature of real estate is such that it's slow to react to changes in supply and demand. So we will always have real estate cycles in the real estate market, always. The key question is whether or not it'll be rational and will not hurt us, or whether it's going to hurt us like it did the last time. So the Appraisal Institute took a look at this, and our response is this. It's contained in what we call Guide Note 12. I believe this was a handout for you today, and it's summarized in this statement near the end of the document. And the guide notes are available for free on our website, and they're available to any appraiser out there that wants to use them. Here's what it says. When necessary, the appraisal report should include a discussion of evidence that the value conclusion may not be sustainable into the foreseeable future. Now, for many of you in this room, that may not seem very profound. And for many people, that may not strike you as being a very big deal. But in fact, it is profound when it comes to the nature of the appraisal profession in the United States today. And it's profound because nobody's been asking us to do it. So it's a major departure, we think, from the culture and the practices that we've had in the business. Now, one of the things we need to do is we need to recognize that there's two types of markets out there. And again, my animation is gone too. I was going to have very dramatic effect there, but at least, for an appraiser, it would be dramatic. There's two types of real estate markets. There's the capital markets, and then there's the fundamental markets. The capital markets are represented by folks that are buying and selling real estate. In other words, it's based upon what people are paying. Whether they're paying prices at the top of the market or the bottom of the market, that's what that market is representing. But there's also the fundamental market, which is represented by the users of real estate, tenants, owner-occupants, and so on, measured by the fundamental demand that's created by those folks. The values in those two markets can be radically different. They can diverge. And there's a lot of confusion when we talk about real estate prices and markets because we tend to confuse these two separate kinds of markets into one. And we forget that prices can diverge from the fundamental values that are out there. Appraisers have been asked to report values in the capital markets for many decades, a long time. And so part of our regulation, part of our culture is such that that's all we do. And we call that point-in-time valuation. But that doesn't help us with mitigating market cycles. And our belief is that it is possible to report values in the fundamental market and help mitigate those market cycles. So if we go back and we get, I am getting the dreaded time's up sign. If we go back and we look at the basic market cycle, if we're reporting a point-in-time value that's at the market peak and not saying anything else about that, then are we really helping our clients? Are we performing what we need? Are we doing what we need to do to protect the public? And we think the answer is no. We think that we need to report not only the point-in-time value conclusion, but we need to report where we are. Is it sustainable? Are we lending into a strong market, or are we lending into a weak market? There's a number of techniques we can use. We're running out of time here to figure out where we are. Some are quantitative, some are qualitative. You have the handout. Here is a list of some of the qualitative things that you can look at to determine that. And we do need the market to understand and recognize that that there is this difference between the buy-sell market and the fundamental market. We have a quote here from a guy with JP Morgan Chase a couple years ago. And he said, what needs to happen now is difficult, but we need to get real estate back to the values it's worth. And that's an admission that we need to recognize that there's a difference between the buy-sell market and the fundamental market, and we need more of that kind of thinking in our view. So we'll go through this very quickly. There are some techniques that the Appraisal Institute has developed. Some of this is not new. It's old-fashioned economic concepts, but we've worked hard to develop and synthesize some of this stuff into practical applications. So some of that is this example where we're doing market analysis. It's a comparison of supply and demand with a forecast. Here's a feasibility rent calculation. The uptake from this one is obviously if it's the rent needed to be feasible is more or less than actual rent, then that gives you some insights as to where you are. Equilibrium rent is kind of a new concept. This is the rent for a property theoretically when you're at equilibrium. And if you can figure that out, you can figure out where you are in the cycle, plus you can also figure out what your exposure is, either on the upside or the downside. So those are some examples. We also have a number of techniques that we've developed for the residential market as well as the commercial market, some of which have already been covered, such as affordability indexes and so on. What are the obstacles and opportunities for us as we go through this? Well, frankly, the business and the lending culture, the business environment today is not conducive to this. Appraisers are fully capable of providing this in-depth, sophisticated analysis, but nobody's asking us to do it. And that's too bad. It's unfortunate because we could be helpful. The other problem is, and I'll be very frank here, the regulation is all wrong. It just is. We're not encouraging this stuff. In fact, we're actively discouraging this stuff with the way the regulation is set up today and the way the business works today, and that's too bad. And I hope that we can eventually get to the point someday where we can rectify that and we can really get to the point where the appraisal community can really be partner and consultants and help people make better decisions when they make loans on these properties. Am I done in time?
That was perfect timing.
Perfect.
Thank you. So next up to discuss, and then we'll have some questions, is Bob Dorsey from FNC.
Thank you. I always feel a little apologetic about critiquing work like this because you know, the researchers do all this work and study and you know, sweat over this for months and months and months, and then someone like me comes along and starts picking at it. And but that's what you asked me to do. So yeah, this is very nice work. It's a long-term study, and it's expected to go on much longer. They're doing a very detailed analysis. They've looked at very intensive amount of data to try and understand what's going on, what's underlying these. And so I enjoyed reading it. I had an opportunity to read the paper, the full paper, and so I have quite a bit more comments about Steve, Ed, and Morris's work than I do about Andreas's work, but I do have one comment about Andreas's work. The one thing that we found, I know that you're trying to develop a hedonic model of the properties so that you can come up with a realistic model of their pricing. One thing that we found when we developed our index was that if the various components of the hedonic model are allowed to vary by location, the components themselves and time, so that you can pick up, say, living area, for example, and allow that to vary smoothly over time, and also the influence of houses that are selling closer to the subject property, or the one that you're measuring, have more influence than the ones that are further away, makes a big difference. And we have the a methodology for that in our Journal of Housing Economics paper that you may be interested in. In terms of this other paper, I only have a couple of areas where I started wanting to pick at it, and one of them is that they make an assumption that the price that you observe is essentially composed of two components. One is the land, and one is the reconstruction price of the house. And we went through a big boom and bust during that period of time, and they, as a result of that model, attribute all of the speculative nature of the pricing, all the speculation pricing, to the land. And that may be just, you know, a nitpicking comment, but I think it's important to recognize that there are really some variation associated with the construction cost, and in higher end areas there's going to be higher end construction that may not all be captured by your model, and lower end construction in other areas. So there is some variation in that. And in vacant land, there's going to be some variation. There's going to be some speculation about vacant land, and there's areas where there's relatively little. But the bulk of the speculation is in a completed home on land at a location. And so it's the composite of that that is, in many cases, what the speculation was about. And in another sense, it's not so surprising that the biggest variation in price was in the lower price houses, because when you think about it, at the beginning of this time frame, there was a lot of impetus by FHA and others for home affordability. And so you're bringing people into the market. They're coming in at the lower end of the market. Those are also the people who have the least wealth to support a downturn in the economy or any change in the economy. And so they're the ones that are most likely to suffer the inability to sustain that. And so in that market where they live is likely to have the biggest impact in terms of price drops. And so it's not unreasonable to expect that that's where you would see the largest volatility. And I got to thinking about that, and I was just wondering, well, how much foreclosure actually occurred in some of these zip codes? And I believe I'm correct in that you only looked at arm's length transactions, right? You excluded the we're estimating land value. Yeah. And what we've found at F&C when we're looking at prices is that if you take a region, a neighborhood, or whatever area you're looking at, and if there are just a few foreclosed properties in that neighborhood, the difference between the price of the foreclosed properties and the price of the arm's length transactions is really quite great. There's a substantial penalty you pay for a foreclosed property in that neighborhood. But as the percentage of foreclosed properties increases, that starts changing that market. And as the foreclosed properties become a substantial portion of all sales, really the arm's length transaction prices drop to the foreclosure prices, and it becomes a market. The price of that market is really a distressed price market. So in areas where you're having a large amount of foreclosures, what the price that you're seeing, the market price, is not really the price of arm's length transactions, but it is the price driven by the foreclosure market. And we went through that recently, and we saw that all over the country, and I think you're experiencing that here as well. And so one of the things that I did, just out of curiosity, was to break this down, and I looked at, I just arbitrarily grouped these, and the zip codes based upon the following definition. And I said that if it had less than 10% of all sales that were distressed, I categorized that as low. Now, for most of you that have any memory at all, 10% is still pretty high, you know. But nonetheless, we went through some bad times. And so then medium was 10 to 20%, high was more than 20%, and some of these zip codes were well over 50% in terms of the number of foreclosures. And so then I took their zip codes and I categorized them into these different groupings. And I arbitrarily picked 4 time periods, 2000 to 2002, which was really sort of before the run-up, 2003 to 2006, which was the big run-up, 2007 to 2010, which was the crash period and immediately following, and then 2011 to 2013, which was sort of the beginning of the recovery. And then I looked at that, and I looked at the patterns of low for each of the zip codes, and you can see that the largest grouping of this was low, 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 low. So I think these are the areas that they identified as the higher income areas where they had financial resources to get through this whole thing. And but I was surprised that the third highest group was high. So then the pre-run-up period, there was high foreclosure. It dropped during the run-up period to medium. Immediately following the run-up to crash, it was still medium, and then high in the recovery period. And I think that is reflective of some aspects that a large portion of this were in a foreclosure process that is more judicial as opposed to the non-judicial, and so it delayed some of that foreclosure process. But in looking at the heat maps of this, I think it's interesting to see the areas where you had high activity and where you had low activity. So here we are in 2000 to 2002. And you can see this area that corresponds very nicely to some of your other graphs, where there was really high foreclosure activity early on. And now remember, that's going to deflate the prices in those areas, which is going to then show a increase in prices down, maybe an exaggerated increase down the road. 2003 to 2006, basically all of that high foreclosure area is gone. 2007 to 2010, right after the crash, and then more recently back to the pattern that was initial. And so what we're seeing is that I think that one thing that they might want to consider is including some of this foreclosure, and I know that they intend to do that, including this kind of as a component to help explain some of that volatility. And it may flatten out the variation if you incorporate that as a descriptive variable in the analysis of that. And and so that pricing can then better reflect actually what's going on. And I don't know to what extent you can capture the speculative nature of the vacant land versus the non-vacant land, but I still think that that's an important thing to consider. So finally, I really like the research they're doing. It's very meticulous, it's well thought out, and I think it's a big advancement in the literature to be able to have this kind of a detailed analysis. Thank you.
Great, thank you, Bob. So I'd like to give each of the presenters 1 minute to have a thought before we go to Q&A. So Andreas, go ahead and take a minute if you have anything you'd like to add.
Thank you. What I would to point out is that what Noreen says about the 2 pillars of valuation and or the 3 pillars that we have. That's what I think what I've done with the direct index. This is a sales comparison approach of the direct housing prices, and on the other hand, the index, which was a pure replacement cost approach, is a second pillar, and that is what we do or what is done in the German appraisal industry. If you go to a mortgage lending value for fund brief refunding, you have to use 2 tiers of this kind of valuation. You have to do a replacement cost approach, or depreciated replacement cost approach, and also a sales comparison approach. And then at the end, the valuer has to decide which of this approach he uses for the valuation. So I think these 2 things are the same side of the medal.
Wait, hold on. Let Steve sneak in a minute, and then we'll go to Q&A. Go ahead.
So first off, I just wanted to thank Noreen, Lance, and Bob for great comments. And I completely agree with what I think is the real bottom line of Lance and Noreen's comments, which is, yes, it's nice to do the research, but it needs at some point to actually impact practices and how the industry monitors risk. And so, yes, we're very interested in trying to work with you to figure out how that can be done. And Bob's comments, thank you very much. We agree with, I think, everything you said, and already are moving toward incorporating foreclosures and loan quality into the analysis, and think we'll have conclusions that mirror what you said.
Thanks, Steve. Go ahead, Noreen. What was your comment?
I just wanted to comment back on the process in Germany. When they have two valuation approaches and two different numbers, is there a reconciliation process, or is there some sort of defensibility about each number and why the appraiser picks a particular number? So that's one question.
I think he has to qualify, he has to do both of calculations, and then at the end he has to qualify for which value he decides. What kind of tier he takes to estimate the final market value for the building or for the real estate.
And another question on the appraisal practice. Is it a point-in-time appraisal like we are currently doing here, as Lance has pointed out?
It depends. If you go for market value, then it's a point in time, or if you go for the mortgage lending value, then you have it's a valuation for the time span of, I think, 5 to 6 years runner.
So that's a forward time span. So it's almost a sustainable value.
Sustainable values.
Okay, so that goes to your point that it's something we need to take in consideration, point in time, based on the facts we have. Is it sustainable? And then I point back to Steve's research that if we could use one of the measures there to identify when the market starts to change, that's maybe when we need to start to change our policy about lending.
Lance, did you want to say something?
Yeah, of course.
Okay.
Well, I miss an opportunity. I'm going to agree with Noreen about the cost approach, but maybe for slightly different reasons than she has. We've moved away from the cost approach over the last few years, and that's unfortunate. Not because the cost approach is the definitive valuation method, particularly for buildings that have been around for a while. It doesn't tell you much about the value of the property, but it is absolutely essential in highest and best use analysis. And if you get the highest and best use analysis wrong, you can't get the value right. You don't know if your project is feasible today. You don't know whether you've got value in the land or value in the building unless you do the cost approach. So I agree with her. We've gotten away from that. We need to get back to it because it can be part of the fundamental analysis of what's going on with a piece of property.
So we'll kick off the Q&A portion. So I'd like to follow, before we get to your question, I have a question. We'll kick it off, but let's follow the same ground rules as the first panel. State your name, and then wait for the microphone, and then state your name. So I'll lead by example. My name's Morris Davis. I'm from Rutgers, formerly Wisconsin. And I have a question for Andreas. And I just would ask for a little bit of clarity in your presentation about something that jumped out. So, Steve, could you, if you have a moment, could you call up Andreas's presentation? If you look on slide 16, in recent years, it looks like there's a huge surge in people that are going to need shelter. Well, we'll get there eventually, but there's just been a large spike in migration, and associated with migration is a demand for housing. If you look on slide 22, okay, if we stop here, if you compare the blue line to the maroon line, I guess is the color, the blue line started in, say, 1998. The blue line declines less rapidly than the maroon line, which means that construction costs are falling less rapidly than house prices. So ultimately, land's value is shrinking there. And then if you start in 2006 and go forward, construction costs are increasing more rapidly than house prices, which means that whatever land share is, land share of house value is falling again. So you get a continuous decline just by comparing construction costs with house prices and land. So you think land is ultimately what has to price people out because it's inelastically supplied. So how can you have a huge demand for housing and the price of land declining at the same time? Is there something wrong?
Maybe this depends on the structure of Berlin. I think the immigrants who gather the demand for housing is for multifamily. The most of the people are going for rental apartments and for housing in the inner city. It's not because the structure of the Berlin market is not a typical single-family housing market. I think clearly here we cannot measure this of course this high demand, but if you compare the prices for condos or rents, they are going through the roof. And if we measure the land value of multifamily, we would measure the land value of the multifamily houses, we would see that also, this effect. I think this depends because most of the people that are coming to Berlin right now are young people, and it's not typical people who buy a single family house. So you know what I mean? If I try to explain, I hope so.
Great, thank you. Okay, questions? The question right here in the front with Christian. Oh, there's a question.
My name is Christian Malagon. I work for the OCC, and I would like to know if you are taking into consideration changes in preferences for housing units, because you are using single families, and the pent-up demand for millennials, it seems to have a change in preference towards commuting time, and at the same time from the unit. And in most of these areas that you are actually looking, there's an increase in non-detached homes. So there's a lot of townhomes, and so I wonder if there's a change in generation and therefore in preferences from going as far as London County while you work in the district. And then that will make a change or a relative valuation on those areas that now are very low in price, but they are next to the district. So, yeah, and the other question is if there's a tipping point in the gap between the very expensive house regions, or zip codes, and the lower zip code that will trickle down the demand for those lower places because they are priced out. And one more question for Lance is that what is wrong with the regulation in terms of the appraisal? How is the regulation affecting that?
That's too long of a question to answer.
Maybe I can just say a couple of words that were related to the research that we did. You're right, this is not every type of house in the metropolitan area, particularly in the district. Most of the housing is not detached. So this is not complete, but there are still a lot of detached single-family houses, and I think the phenomenon that you're talking about, they have impacts on the prices of houses and the prices of land that are relevant to be tracked going forward. In particular, I agree with you. I think there will be diminishing demand for housing at the periphery of the city because preferences are changing, and that's something that we need to keep track of. I mean, you can see it already, this trickle-down that you're talking about. People went to the periphery because it was too expensive in the middle, and maybe that will happen less.
There's a question over here, and then we'll.
Thank you. I'm Andrea Psoris, and I'm a bank analyst, and I'm a member of the New York Society of Security Analysts. Perhaps the problems in the EU have caused the fall off in the land values because people who, the construction costs would reflect higher labor charges. However, the land values would perhaps reflect that there was a spike in the prices that during the time after German reunification the people would have had a great aggressive acquisition of land in Berlin, and so that's why the land prices spiked. And then in time, as those that demand was satisfied as well, then the EU commercial problems, the commercial erosion over time has gone about, and people tend to stay when they're nervous about jobs, when they can't find the kind of home they want, and so housing values would track down. So perhaps a parallel chart in the United States would be a large metro area to see if, you know, that has suffered a waxing and waning of, you know, commercial with deindustrialization that's happened in the United States. You know, perhaps Philadelphia or something like that might be a reflective, you know, like, or I don't know that Detroit, but so my question is, do you think that the commercial problems in the EU and then what happened immediately after German reunification would have caused some of the influence on the chart, and how then do we understand here in the U.S. how we can see where we've got comparability or contrasts?
Okay, I will try. Okay, there was, of course, a big bubble after the German reunification. There was the euphoria after the unification Germany, and all the analysts have said that Berlin will go up to 4 million people in no matter of time, and it was a huge run to Berlin, and then the bubble burst. Yeah, there was, you can see it in '69. I must say the data is really dirty for Berlin for this time in the beginning of the land value data we analyzed. So maybe we have to use hard copies to put the data out, and then we have to put it on a zip code level. And it was very difficult. But one remark: what you have said, Maurice, that the picture was direct measured from the land values from the local real estate survey commission, and here in this slide I have is a direct measurement, as a digital measurement of if I use the house price and a minus cost. So here you see much more dynamic at the end, and you can see the dynamic at the end. Maybe it's of course because the land value committee consists of I think in Berlin about 10 people who are doing that voluntarily, and they do it once a year. And the data they use to estimate the land values on a sales comparison approach is 1 year lagging. So maybe this effect comes here in this chart. You can see it here, and the residual measure with its faults and errors it has, with speculative elements and so on, it's much more right about, I think, about the land value here in Berlin at the end of the time. Thank you.
Great. We have time for just one more, I think, a brief one. Should I flip a coin? Who? Oh, go ahead.
Thank you. My name is Bill King. I'm with Platinum Data Solutions. My question with regard to the land values and the changes that you saw in the early part of the 2000s, there was also a pretty wide change in the amount of builder profits that were being experienced during that time. How did you deal with that in this analysis?
That's a good question. It actually goes to one of Bob's comments. The construction cost indexes, and therefore the land prices that we're doing, assume a constant builder profit margin over the cycle. So to the extent that the profit margin on the builder side was widening, some of the price increase that we're attributing to land could have actually been structure. It would have to have been an enormous, massive widening to, overturn the basic results. But it does mean that the numbers shouldn't be viewed as, coming down from on high. They're estimates, and that is one of the things that probably makes them a little bit off.
And Steve, did you use the Marshall and Swift cost indexes? Yes. Okay, so they would take in account of overhead and profit to a certain extent as well.
My understanding, unless I'm wrong, was that it was like a fixed percentage and it didn't vary with the state of the cycle.
So it was a market basket of goods, right? But we did see it move up. So you should have seen some variation of that as the price, but it wouldn't have been as as a higher profit, right? When it goes off the charts, it's only moving slightly up in the indexes.
So let's conclude this session. I've been asked to ask you to, of course, enjoy all of the fruits of lunch, but do so quickly. Grab your lunch and come back to your table quickly, as we've got a valuable and informative session about to occur. So let's break for lunch, and thank you very much for a lovely session.